Hello everyone, and welcome to our market alert video for today, which is October 9, 2025. I hope that all you clients and squippers are having a great time, and especially those of you in Squipper Nation, I hope you are out there enjoying your second childhood without parental supervision. And those of you who are not retired yet, our goal is to get you there happily and prosperously. So I hope that this video finds you well. We're going to have more fun than a human being should be allowed to have when talking about all this boring financial stuff, as we always do. And so let me go over with you what we're going to talk about in this, our weekly excursion into the land of finance. So first of all, you may have noticed that gold has been hitting massive new all-time highs. It's been going through the roof. So what's driving that? Also, speaking of new all-time highs, the market just set, I think it's like its 70th new all-time high, which maybe might make you think that we should sell. I mean, this market's gone crazy, hitting new all-time highs all the time. And so, maybe it's a top. So we'll give you a little bit of a historical perspective when it comes to all-time highs. And then continuing our theme about AI and are we in a bubble? And more, it appears that maybe we are. And especially what I love to hear is that this time it's different. Okay, that's usually not a good sign when people start saying, you're comparing it to like the Dotcoms, but this time it's different because, the Dotcoms, these were companies like Pets.com that had no money, no revenue, no nothing. And yet their stock price was through the roof. And these are companies like Microsoft and IBM and others that's not the case. So this time it's different. And so we're going to explain why we think that it may not be different. So we have a lot to talk about this week. But before we get into it, my youngest daughter, as you guys may know, is now engaged. And so the planning process for the wedding has begun in earnest. Because the wedding is about a year from now. And what's really interesting to me is that the negotiations between me and my wife and my daughter, it's worse than the government shutdown. I mean, you think the Democrats and the Republicans and their negotiations are tough. You ought to be in one of our budget meetings. Holy mackerel. But you may have noticed I did not include in our topics this week the government shutdown. So just let me say that we think that this will go on maybe for 3 or 4 more weeks. This may be the longest running government shutdown in history. But President Trump took some measures in this particular, after the last one, to protect the government against future ones. So it's not going to be, for example, getting paid to military people, etc. So that kind of thing is going to make this government shutdown not as painful as maybe others have been, and therefore we expect the impact on the markets and our investments to be muted for that reason. And also why it'll maybe last longer because there isn't as much pain involved. So we think about 3 to 4 more weeks before they finally come to some conclusion, and then, they'll pick it up in other ways after that. So let's talk about gold. One of the things that, if you look back at history, gold has gotten this reputation for being an inflation fighter. Whenever inflation is high, gold is like the answer. And so right now, we don't have very high inflation, and yet gold is going through the roof. So why is that the case? Well, historically, gold has not been an inflation fighter. The way it got the reputation of being an inflation fighter is that back in the early 80s, when we had the hyperinflation, what happened was that people were terrified. Our economy was on its back. The dollar was falling like a stone. It looked like we were going to become a second-rate nation. I mean, it was really bad news. And so that fear is what drove gold prices up. People wanted to put their money in something that they felt they could hold on to and that it was going to be there. The dollar was falling, the economy was collapsing. So it happened at the same time that inflation was going up. And so because of that coincidental interaction, people said, aha, that's the answer to inflation. It's gold. But we've seen many times where gold has gone up without there being significant inflation. In fact, that's one of the few times that it did actually happen. So that reputation was earned by essentially a black swan event, but has not been the case even now. So the next thing you look at is, fear. Are people scared? Well, right now it's the opposite. I just said, we're on our 70th new all-time high. So people apparently are not scared. The economy seems to be okay. Things are good, jobs, etc. So there doesn't seem to be panic or fear right now. So therefore, gold, but yet gold is going up. So why? Well, there is a little bit of a concern about, the dollar falling and all that kind of thing. But sometimes these things take on a life of their own, and they start going up because they're going up. And as they start to rise, people buy them. We just heard that China is going to start loading up on gold. And so because of that, it's like the buying causes it to go up, and that causes more people to buy it, and that causes it to go up more. And that's when you end up with a mini bubble in gold, if you will, that could be developing. So the question you may ask is, do we have gold in our portfolio? We're very, very diversified. And so precious metals is part of our portfolio, but not a very large percentage, just to be clear. So let's talk about that new all-time high thing. So I did the math on this, because it's kind of hard to get the actual numbers of new all-time highs that you experience in a normal bull market, because it depends how you define it and all that. So I've done some research, and it's all over the map. So I did my own math. All right, so bear with me on this one. So the average bull market, which means from the end of the previous bear market to the end of the current bull market, that period, it's about 1,000 trading days, okay? And generally speaking, the market during those 1,000 trades is going up about 60% of the time. Now, it takes a while to get back to the new all-time high because you're starting at a low, right? You're starting at the end of a bear market. So looking at that kind of math, what I've come up with is that on average, you might expect 70, 100, somewhere in that range, new all-time highs in an average bull market. So right now we're at 70, maybe 80, depending on who you ask. So, and if you think about it, for a bull market to actually happen, every time it goes up, you're going to have a new all-time high, and it's higher than the day before if that was a new all-time high. So is it something for us to be, overly concerned about? No, it's a natural, normal part of what happens with a bull market. You get new all-time highs by definition. And so it wouldn't surprise us if we didn't see another 30 new all-time highs here over the next few months. And in fact, we think it's very likely given where things are headed and what's going on right now with the economy. So new all-time highs are not unusual. They start to get headlines when you start getting this how many we're getting. It's oh my gosh, how many more can we possibly have? So probably we would say somewhere around another 20 or 30, and then maybe start worrying. Now, what is driving these new all-time highs? Well, of course, that's AI, right? A lot of the AI companies are spending massive amounts of money, and they're actually showing profits for it. So that is therefore driving a large percentage of the growth in the S&P and the Dow, the stock market. Now, in last week's video, Jordan and I went over, is this a bubble building? Because in the last big bad bear market we had, or the one prior or the one before that in Y2K, we had the Dotcom crisis, right? The Dotcoms became a huge bubble, and then when it popped, it took the entire market down with it, almost 50%. So, and it lasted a long time, almost 2 years, 2.5 years. So this was so there are a lot of similarities going on right now, where those dot-coms, technology, internet companies that were building out the infrastructure of the internet, those companies drove the market to massive all-time highs. And they represented, at the peak, about 30% of the value of the entire stock market. So when they went down 90%, 27% of the drop in the market was attributable to just those companies. and the rest was because people were panicking and the rest got sold. So are we in that place now? Not yet, but we're pushing 27% of the infrastructure-related companies that are building out the AI infrastructure, if you will. So, and over the last 2.5 years, those stocks are up, 250%, very similar to those companies that built out the internet. So a lot of similarities. And what they say, history doesn't repeat, but it rhymes. So we have to be careful, and we're watching that for you. Now, what I've heard, which kind of made me laugh, several people on the Talking Head shows that said that, this time it's different, okay? Because last time we had Pets.com, for example. This was a company that had no profits, no customers, but because it had .com on the end of it, its stock price was at like 30 times, 30 times nothing, right? They had no profits. So it was an infinite valuation based on nothing. And so, but this is different because these companies, Microsoft, IBM, these companies have profits. They have lots and lots of cash. I mean, Microsoft has hundreds of billions of dollars in cash. So these companies are not going to go out of business like Pets.com did. And so therefore, this is different. It's a completely different scenario. Well, from that standpoint, it's true. But what could happen is that the prices of these stocks are so overvalued that reality sets in and investors say, wait a second, where's the beef? And when that happens, the stock price could fall 50% or more without putting those companies out of business. Because it's true, they have tons and tons of cash. They can withstand a storm very well. But it doesn't mean their stock price doesn't experience a big drop because it's overvalued. And that big drop could stay down for a long time. And if those stocks do crash, and they represent 30% of the stock market, as the dot-coms did back in Y2K, then people will, there's just this whole psychology of, oh my gosh, the stock market's going down, I got to sell all my stuff. And so people start selling, and selling begets selling, just like buying begets buying. And you get the big bad bear, and then you're waiting around for what's going to happen with this AI. It's not working the way it should, and it takes a while for that to happen, as is the case with the internet. Yeah, it's working, but how do you use it? How do you make a profit? That took about 2 years to figure out. And so you get a big bad bear. So not calling for that, not saying it's going to happen, but saying that it is certainly looking like it's rhyming, if you will. And so, and when I hear several people say, this time it's different, I start to get worried. And also, to quote Groucho Marx, any club that would have me as a member, I don't want to be a member of. So if the entire club is all about nothing but, the sky's the limit, these stocks are going to just keep going up and nothing can stop AI, it's going to transform and all that, when everybody's jumping on board with that, that's when I start to think, maybe I don't want to be a member of that club. And so the caution that I would recommend at this point, given that, is important. So what are we doing about it? Of course, we have our invest and protect strategy. And if you look back over history and you look at how it would have performed back in Y2K, and then also how it did in 2008, it is well designed, in our view, to protect against a big bad bear market if that in fact ensues. So I hope that this gives all you clients and squippers peace of mind to let us worry about all this boring financial stuff so that you don't have to get the gray hair. Somebody commented that they saw a picture of me from even 5 years ago, and apparently I've gotten a little grayer since then, so comes with the territory. But it's okay. I enjoy it, and there are things I can do to affect that. So I'm not particularly worried about that either. If I want to, I could go back to that color pretty quickly. So thank you for your concern. So but in terms of our sleeplessness with regard to all of this, not really. we feel very confident in our strategy, our invest and protect strategy, to help us to navigate through if this in fact turns out to be a storm brewing. I want to invite you to take advantage of an offer, and that is to come in and visit with one of our retirement planners regarding your retirement planning. And if you do that, we'll visit with you. We offer you 2 visits. The first one is where we get to know you, understand where you are now, what your goals are, how you're invested, all of that good stuff. Then we invite you back for a second meeting. At that time, we'll have very specific recommendations. We'll talk about how to protect against the next bear market the way that we think you should. And then at the end of that meeting, we'll go over any costs involved in implementing what we've talked about. If you like what you see and you want to work with us, that is fantastic. And if not, that's fine too. Either way, there's no charge or obligation, and we will part friends. So please go to our website and take advantage of that opportunity. And again, thank you for watching the video.
Retirement Planners of America.